Okay, folks, welcome to the Contrarian Traders 2017, the year ahead forecast. This is Bob Desmond, and welcome to our 11th year in business. And what we're going to do today is we're going to talk about our year last year. Then we're going to segue into some of our predictions from last year, how they worked out, as well as we're going to talk about how the markets look moving forward. What do we see for 2017? So let's begin with our performance for 2016. We had a mid-year return going into July the 1st with a little over 400% return. We ended the year at 217%. And we're going to talk about how we get up to the 400% return first, and then we're going to talk about what happened. Why did we pull back from 400% return and only end up with a 217% return at the end of the year? By far, we outpaced the market, but we could have done better. And what we're going to try to do is we're going to try to learn from our lessons from the second half of the year. So let's begin with the TZA. We went into the year bearish on the market. And what I specifically said about the U.S. stock market for 2016 was that you can go back and take a look at my 2016 the year ahead forecast. It's posted right on the blog. Look below and you'll see it there. And if I can, I'll link to it on this video as well. So what I mentioned going into 2016, quote unquote, what will save the year is a horrible first half. Why? It was a presidential election year. Markets generally do strong in a presidential election year. And secondly, Janet Yellen is the Fed governor, very liberal, and they wanted Hillary, and they primed the markets for Hillary, keeping yields very, very low throughout 2016. So let's talk about our trades. We went into 2016 fairly bearish on the market. I was not net short going into 2016, but we did the first day. We went big time short of the Russell 2000 using the TZA, and we booked profits near the highs as we began to flash these topping tails. So we kicked off the year very, very strong, and we did not spend a good part of the year short. We did not fight the market until November, and that's where we kind of got into trouble. But let's stay on our winners first. BRZU. I predicted that the US dollar would probably see a pullback because it was overbought going into 2016, and we got it. That set the stage for a rally in 2016 of the emerging market plays. We went long of the BRZU, which put you long of Brazil. Now, these are leveraged ETFs. The TZA, the BRZU, leveraged ETFs, they move 3 times the move of their underlying index. So that's what really fueled our performance for the first half of 2016. What else fueled our performance? Well, we were bullish on the gold mining names going into 2016. We were building positions. We were adding to positions on breakouts. We were buying strength throughout the first half of 2016. What else were we doing with NUGT? We were selling premium, meaning we were selling covered calls. If we were taken out of our position, we would then sell naked puts, and then we would get long once again as we had those shares put to us. So it was really the NUGT that really was the whipped cream and cherry on the cake that sent our profits so incredibly high in 2016 going into the mid-year. Now, unfortunately, with NUGT, it's also what kind of hurt us as well, because while we scaled out of 2/3 of our position near the highs, what hurt us was maintaining a 1/3 position and retracing a good portion of the move down lower once again. And we had an opportunity after the election to sell strength. I didn't take advantage of that. What I chose to do was to sell covered calls, which is not the best strategy when you have the NUGT or any underlying component in a downtrend, but I figured that the markets or the gold markets would rally once again with President-elect Trump being elected. And overnight, on election night, gold was up $50 overnight, and then the next day it gave a vast portion of it back. So we ended up selling covered calls, and unfortunately November into December really hurt. We began adding to our position very, very close to the lows in December, and we saw a nice rally back. So a really outstanding year. Could have been better, but hell, we certainly beat the hedge funds out there. And while, yes, we accepted a great deal more risk than what many people could tolerate, you could have always just traded. In the case of NUGT, you could have bought the GDX. It's far less volatile. In the case of BRZU, you could have bought the EEM, which would have put you along with the emerging market plays. I'm sure there's a single play out there for Brazil, and you could have traded that less volatile ETF. In terms of shorting the Russell 2000, you could have simply just shorted the IWM for less volatility. So there are ways to trade along with us without having to accept as much volatility as what we're willing to accept here at the Contrarian Trader. So even if you had taken that path of trading the less volatile ETFs, you would have still far outpaced the overall markets, no doubt about it. Now let's talk about the other predictions that I made for 2016. And again, the 2016, the year ahead forecast is pasted right below this video. So you can go back and check it out. And as I mentioned earlier, I'll try to link to it on this video as well at the end. All right, so going into 2016, I was fairly bullish on India. And the shares did not perform as what we had hoped. And in fact, they had broken down below the lower band of this rising uptrend channel. But they did reverse off the lows of the year and closed up 2%. And the reason why I was bullish on commodities was because of India. Not so much China, I'll get to that in a moment, but India more so. Now, what happened with India? What happened with India is that their Prime Minister Modi, he decided that he was going to really mess with their currency. And because they have a huge black market economy, and what he did was he took, in US dollar terms, he took their $50 and $100 bills out of the market, which just caused a great deal of indecision and havoc. So would I go shorting India right now? No. I wouldn't do that. I think that if we break down below 2,000 on the India Bombay Stock Exchange, the 30 Sensex index, then yeah, you would short it. Right now, I see consolidation here. And if we break out above, let's call it 31,000 on the Bombay, I would look to buy that index, but not right now. Healthcare. I was very bearish on healthcare going into 2016, and in the end, it did close down 2.7% on the year, and it was down considerably lower at one point in time. So healthcare is consolidating. I have a strategy. I'm going to go over that for the 2017 predictions in a moment, so bear with us. But XLV was down last year as predicted. Japan, I predicted a very strong year for, and we got it. It was up 18.88% on the year, and it looks poised to move higher. What could derail the Japanese stock market is the Japanese yen strengthening, as it appears to be doing right now. Not so much strengthening as it is putting in a bottom. The XLY. I was bearish going into 2016, and correctly so. We pulled back rather dramatically. Now, why was I bearish? I was bearish because we had lower highs getting put in on RSI. We had broken down below the lower band of the rising uptrend channel. Never, ever good. Volume to the downside going into 2016 was very high. and that is quite bearish. Now, when we moved into the lows of January and then into February, we were flashing bottoming tails. We had a bullish key reversal in February. That was a signal that the sell-off was over and it was time to get long. Energy moving into 2016. I mentioned that we would probably retest the 2010 lows, and we came very, very close to retesting that low. We flashed some bottoming tails, just as we saw with the XLY, and the shares rallied back. I did mention that we should expect to see a weak early 2016, and we got it. And we'll go over energy as I speak about predictions for 2017 in a moment. Now, my favorite trade going into 2016 was telecommunications, and the IYZ, it was up 22.76 for the year. So a really good trade, I think, on our part. And at one point in time, it was even higher before it backed off. And I'll be talking about the telecom sector a little bit more in a few minutes as we talk about our predictions for 2017. The US dollar. Going into 2016, I was bearish on the US dollar, and correctly so. But as we retested breakout points, meaning we had broken out, this is a quarterly chart, we had broken out Q4 of 2015. We then pulled back Q1 of 2016. We retested the breakout point again. It took a year, but we retested it, and that sent gold, which is overlaid here. We were long of the gold mining names and made a lot of money on that trade. And then after the Brexit, you saw the positive correlation between gold and the US dollar break, and the dollar rallied and gold broke down. Now, for the past 2 years, I've spoken about commodities, and in particular the GSG, which is a basket of commodities. And going into 2014, I was bullish. They rallied, then they broke apart. Going into 2016, they rallied. As predicted, we were bullish, and then they fell apart. However, now what we're seeing is, despite the fact we have a rallying US dollar, commodities are breaking out. We broke out above this upper band of the declining downtrend channel. We reversed off of the lower band of the rising uptrend channel in November 2016. We have a real serious breakout in commodities. Take note of the higher lows on the stochastics, on the RSI. This is a huge breakout on a monthly chart, and it cannot be ignored. So as we move into 2016, I think it's going to be a year of things. And what do I mean by that? A year of things means I want things that I could touch, meaning gold, silver, steel, agriculture. And you may be saying, I don't hear the pundits on CNBC talking about these names at all. They're saying that we're in a deflationary environment. There is no inflation. Well, these charts are telling you a different story. That when you see commodities rise, that's inflationary. That's the input costs for producers. They're rising. Here's the DBC. This puts you long of the miners. We are in an uptrend, and while yes, we are at resistance, we look poised to break out. Take note of the weekly chart of the DBC. We broke out in November, we pulled back, retested the breakout point, and we are now rallying in advance of price. So we have a leading indicator, leading price performance on a breakout. Take note of Ultimate Oscillator, doing the same. Very, very strong chart. I think that commodities are going to be the place to be in 2017. The only round hole that needs to be squared is, well, if you take a look at the US dollar on a quarterly chart, it looks pretty darn strong. So what that tells us is that some commodities are going to do better than others because they are less inversely correlated with the US dollar. Case in point, steel, less correlated with the US dollar than what is gold. Now, when I talk about commodities, you want to ask yourself the question, is it appearing in the government's economic data? It sure is. This is a monthly chart of the producer price index. It measures the input costs or inflation at the producer level. This is a threat to the stock market moving into 2017. Now, the PPI was in a downtrend. That downtrend ended back in March of 2016. We've rallied. We broke out in July. We've since pulled back and we've been consolidating. We retested the breakout point. My guess is that we move higher very, very early in 2017. Take note of your stochastics, both lines, fast and slow, trading above 50, very bullish stuff. Higher lows getting put in on RSI, monthly chart. So I think that the inflation word is going to make it back into the lexicon of the talking heads on Bloomberg and CNBC in 2017. As much as they don't want to talk about it, they will be fairly soon. Tips. Weak during the back half of 2016, but strong in the past couple of weeks. We've retraced the lows going back to May of 2016, and we are consolidating. We reversed off the lows in December. We appear poised to move higher. If we get a breakout above this upper band of resistance, you're going to see questions get asked. Why are the tips breaking out when the Federal Reserve tells us that we're still below their inflation targets? So keep an eye on the tips. I'm bullish as we move into 2017. Agriculture. A beautiful W formation setting up here. We had bottomed out in February of 2017. We retested that bottom and held back in November, and we are now beginning to rally back. If we break out above this upper band of resistance, expect agriculture to rally in 2017. And that will be inflationary. Take note of the coiled spring that are the stochastics. Higher lows getting put in. They appear poised to break out, very bullish. Other threats to the U.S. stock market. I've been talking about the Shanghai Composite. In fact, we've been short of the Shanghai Composite since it broke down below this lower band of support here. I spoke about the Shanghai Composite last year during the week ahead forecast. I predicted lower lows. We got it. Then we rallied back off of those lows. Now we're beginning to break down again. The concern I have with the Shanghai Composite Index and the U.S. stock market, and the reason why the Chinese markets are a threat to the U.S. markets is not so much because of the Shanghai Composite. The threat is a devaluation of the yuan once again. And the last time we had a major devaluation of the yuan was back here, August of 2015. And you saw what happened to the Shanghai Composite. And overlaid here in blue is the S&P 500, both of which were hammered like baby seals. The window I am referencing is between now and Donald Trump's inauguration as President of the United States. All right, so now let's take a look at the markets moving forward into 2017. What do we see happening? And I've already gone over the GSG, the DBA, and the DBC in the previous segment to discuss what I believe is a bull market in commodities. So let's now talk about the Dow Jones Industrial Average quarterly chart. And I've spoken about this chart for the past 2 years on the year ahead forecast. And here are the two data points that form this uptrend channel, the upper band of the uptrend channel. The first time we created this data point was back in 2000. Subsequent to that, data point being hit, we broke down and had the dot-com crash. We then rallied back into 2007, and we formed the second data point on this quarterly chart, and that resulted in a correction caused by the financial crisis. Here's where we are now. Fast forward. This time last year, we were still trading down below this secondary upper band of resistance. In Q1, which is here, we broke down below the lower band of support. Then we rallied back, flashed a bullish key reversal on the quarter, and the rest is history. Now, going into election day, the markets were beginning to fall apart, but the market was able to break out above the extreme upper band of resistance on this quarterly chart. Now, we formed a rock-solid base that began back in January of 14. It was retested back in January of 16. No doubt about it, a very strong base. A 2-year consolidation, which set the stage for this rally. Now, if we close out Q1 or Q2 of 2017 back down below this dotted blue line, the upper dotted blue line, that will be a breakout point failure, which in all probability means that we will retest the primary lower band of support. If we break that, it's all over. We're going a lot lower on this market. But as it stands right now, the path of least resistance for the Dow Jones is higher until it is no longer higher. Now, when you drill down to a weekly chart, you can see that we went parabolic after the election. The final week of the year was down. So I believe as we move into Q1 of 2017, we're going to see some weakness in this market. Perhaps it won't be as it was last year, where the market sold off right away, day one, gap down lower. They may wait until Inauguration Day, much as they did with President Reagan when he was inaugurated, and then begin to sell this market off. Now, when you take a look at the S&P 500, very similar to the Dow Jones Industrial Average in terms of price action. The problem here, unlike what we had in 2015 as we entered 2016, is that we had a market back then that was, it had a PE, the S&P 500 had a PE ratio of 21.54. It now has a PE of 25.76. So this market is poised for perfection. Now, earnings are coming out soon. So with the US dollar rallying, that's going to put a lot of weight on earnings made overseas by the S&P 500 companies. And while many are predicting that the earnings trough is now over, we'll see what Q1 brings. Now, while we broke out on price and made new highs, when you take a look at indicators like the ultimate oscillator, not confirming the breakout, rolling over on Stokes, MACD, a possible head and shoulders setup, left shoulder, head, right shoulder. Here's your neckline. So the S&P 500, the Dow Jones, all very, very overbought. And when you take a look at the total market advanced decline line in black and red, we are now putting in a lower high. You can see I drew a dotted blue line to connect the new lower high from the prior higher high. No breakout yet on RSI. Overlaid in green are the triple Qs. In gold, the Russell 2000, and in blue, the S&P 500, all of which are really beginning to roll over now, with the Russell 2000 in particular putting in a lower high. We are currently short of the Russell 2000. Ultimate Oscillator, lower high. Stochc RSI, lower high. Remember, this is the total market index, the Wilshire 5000. It looks like we may have a bull trap forming on MACD. It gives the implication that it will move above the red line, the slow line, only to fail and break down. The VIX. As we moved into 2016, we were here. We closed with VIX in the last week of December of 2015 at 18.21. At current, we closed at 14.08. So we're considerably lower on the VIX. We most recently touched 10.93 for the first time, a 10 handle since 2014. So we're coming off of very oversold levels on the VIX, and we are poised for a possible breakout. If we break out on VIX, that means the S&P 500 is falling. Take note of RSI hooking up, no breakout yet. Stochc's hooking up. Beware the VIX. As the old saying goes, when the VIX is low, you gotta go. When the VIX is high, you gotta buy. So just be careful moving into 2017 of the major averages. The 10-year yield. Now, one might seem it strange that the 10-year yield in the final weeks of trade of 2016 fell. But didn't we get a final read on GDP of roughly 3.5% GDP? Well, the only thing that they don't really tell you when they give you that number is that the vast majority of that GDP number, roughly 1.1% of it, was from a one-time surge in soybean exports. Herein lies your pullback on the 10-year yield. And when you take a look at the monthly chart of the 10-year yield, while we broke out last month, we flashed a doji star formation. That's a sign of indecision. If we drop back down into this trading range, the path of least resistance is going to be a bias to a neutral move until we see a Fed rate hike, if we see one in 2017, to the downside. This will be a significant breakdown on yields. And one might be saying, Bob, the talking heads on CNBC and Bloomberg have been telling us that the bubble in bonds has burst. It's all over. Hogwash. When you take a look at the monthly chart of the 30-year bond, we have yet to break this lower band of support. The bull market rally, which began back here in the early 80s, is still alive and intact. And in fact, you can see here that we are holding support at the 50-period moving average on a monthly chart. So while, yes, this chart is quite bearish right now for the 10-year bond price, it's certainly not a bubble that has ended. Might we go lower and retest the lower band of support? Absolutely. We'll discuss a breakdown and the end of a bull market in bonds once we broke down and closed below this lower band of support. We're not there yet. That conversation's not to be had. And be suspect of anybody telling you that the bond bubble, the so-called bubble, has burst. I'm not saying that they're wrong. They may be proven to be wrong, but they're a bit early in their call. The US dollar, another threat to the market moving forward. Why? About 47% of the multinational companies based in the United States derive their earnings from overseas. If the dollar is strong, our goods are more expensive and less gets sold. Simple as that. So the US dollar has reached resistance at 103.62. Last week it flashed a bearish key reversal. Now, as I'm taping this on January the 2nd, the U.S. markets are closed, but the currency, the FX markets are open. The U.S. dollar is rallying versus the euro and the yen. And we'll talk about the charts of the euro and yen in a moment, because I don't think that the rally in the dollar is going to last a lot longer. I think it's under threat right now because Donald Trump has made no secrets about his contempt for a strong U.S. dollar. He wants to bring manufacturing jobs back to the United States, and to compete with the Europeans and in particular the Asians, you need to have a weaker U.S. dollar. Moving into 2016, I mentioned that we would probably see parity with the euro. We came close, we didn't get there. Now, when I'm talking about what I expect to be weakness in the US dollar, perhaps in the short term, is due to the chart of the euro. You could see that the euro bottomed out back during the week of December the 12th, and we've been consolidating. Now, if we break down below the support level here in green, it's going to be parity with the US dollar, no doubt about it. But as it stands right now, we're holding support. And we may just see a rally in the euro. Take note of the Stokes hooking up, RSI hooking up. Volume has been light during this consolidation to the upside. MACD histogram is a bit mature. Looks like we could get a rally on MACD. Now, when you take a look at the chart, weekly chart of the yen, you can see that it too bottomed out during the week of December the 12th, along with the euro, and it's had a dead cat bounce. Is this to be bought? No, it's certainly not to be bought, unless, of course, you pull back at a double bottom retest on the yen. And that may be exactly what it's doing right now, pulling back, and it'll attempt to retest 81.34. We'll see whether or not we get a high or low put in, and then if we get a breakout above this pivot point seen last week. Volume dropped off last week as expected. So that's the currency story. What could hurt the euro? What could hurt the yen? What could strengthen the US dollar? Any number of things. Geopolitically, what I'm concerned about in Europe is Turkey falling. Why is that? Turkey's not in Europe. Well, one could argue that it is the doorstep to Europe from the Middle East. And they have a lot of problems going on over in Turkey. We came into 2016 with a migrant situation. That's still a big problem. If Turkey falls and becomes an Islamic state, which it appears it's on its way to, the doorway to Western Europe is left wide open. They are also a NATO member. If that occurs, I would expect to see the euro weakness. Now, what could hurt the yen? China. You have escalating tensions going on over in China. Also, North Korea, a big threat. Not to mention the capital outflows coming out of China. In fact, shares of Bitcoin are surging in China right now. The price of gold is seeing a $30 premium in China versus spot anywhere else in the world. So we have some really serious geopolitical events that could unwind this market. Now let's segue into the major industries for the United States and see how they're setting up for 2017. And we'll begin with the consumer staples, the KXI. And the consumer staples did not have a great 2016. In fact, they pulled back and retested the lows seen earlier in the year in December. The reason why I'm bullish is because that support level held and we flashed a bullish key reversal in December. Now, if my opinion regarding the market is correct and we see a Q1 correction, well then, that is going to send the staples higher because that is a safe haven play. So consumer staples, we are bullish on moving into 2017. So as we proceed into the first half of 2016, we are bullish on consumer staples. IYZ, US Telecoms, this is my number one pick for 2016. Again, that return was 22.76%. But the last week of the year saw a bearish key reversal. We held support. Would I go selling now? No, as long as we hold on to this key support level. What I will caution, though, is that we're seeing lower highs on RSI. And we do have resistance above at the 35.56 level. But when you take a look at a monthly chart, the uptrend is still healthy. We're a bit overbought. Now, if we begin to break down below these lows here at 30.85, you need to think about your position, lighten up on it, and perhaps take some profits off the table, because that would be a significant breakdown, because this was a rock solid consolidation level, and if it breaks, not good. So while I remain cautiously optimistic on the telecom sector, if they break down below this key support level here, you need to stop out of your position, at least partially. But when you take a look at the indicators, they continue to make higher highs. Stokes are making higher highs. Good volume bars. So I still continue to believe the path of least resistance for telecom remains higher into 2017. Consumer discretionary, unlike consumer staples, I am not as optimistic on the consumer discretionary names because they broke down. We had broken out above this upper band of resistance the week of November the 21st, broke down, lost that support level the following week, recaptured it the week of December the 5th. We have now lost it once again. So we have a bull trap on the XLY. I think at a bare minimum, we're coming down to retest this lower band of the rising uptrend channel. If that breaks, we're coming down to 76. If that breaks, it's all over for the XLY for 2017. Note the lower highs on Ultimate Oscillator. Head and shoulders setup forming. Left shoulder, head, right shoulder on MACD. So caution flag is on the track for the XLY. And on a monthly chart, you could see that we are putting in lower highs despite the fact we're putting in higher highs. The month of December, we saw a reversal month, a failed breakout. If we break down below 75, 77, it's going to be all over for a while for the consumer discretionary names. Volume last month to the upside declined. Lower highs getting put in on Ultimate Oscillator. Sloppy price action on Stoch RSI. Very, very extended here on the Stokes. I would avoid this sector early on in 2017, revisit it later on in 2017. XLK, weekly chart. This is the technology sector. Now, while we've been putting in higher highs week over week, with the exception of last week, take note of the RSI, which is a leading indicator. We're putting in lower highs. That's a bearish divergence, not good. You would expect to see RSI making higher highs as we made higher highs on price. It wasn't doing so. Take note of the failed breakout on Ultimate Oscillator, lower highs on Stoch RSI. Head and shoulders setup forming on MACD. Left shoulder, head, right shoulder. Here's your neckline. Look out below for the XLK if we break down below this key support level at, let's call it, $48 per share. And if we break down below this lower band of the rising uptrend channel, it's all over for the XLK for at least the next several months. Energy. So we were overbought on energy. We flashed a hollow candlestick the week of December the 12th. And that was a sell signal at resistance. When you see a hollow candlestick, that means get out when you're at the top of a trading range. And sure enough, we've pulled back. I expect to see a continuation pullback on energy. Longer term, though, if the economy holds up, we may see higher highs, monthly chart. Take note of how bearish the energy sector was early on in the year due to the high yield bond crisis and the declining price of oil. Oil stabilized. OPEC has since gotten their act together. We bottomed out. Beautiful rally on the energy sector. We broke out in June, and it's been off to the races ever since. Bullish key reversal in November after retesting support. But last month, we flashed a doji star formation at the 2 standard deviation Bollinger Band in green. Does that mean it can't go higher? Of course not. It sure can. But my guess is with this sign of indecision, we're going to get a pullback and a retest of the breakout point. As far as I'm concerned, until we break this lower band of the rising uptrend channel, the energy rally is intact. But I will caution, volume dropped off in December. So energy, short term, somewhat bearish, longer term, still bullish. The industrials. So the industrials have broken down now. They were in a strong rally. We hit resistance at 123.18. Profit takers moved in. We broke down last week below this lower band of support. Lower highs have been getting put in all year long on the industrials. Take note of the MACD, which while we made a new price high, the MACD was unable to hit the upper band of its rising uptrend channel. That's relative underperformance on the MACD. That's a sign that momentum is waning. So I would be very, very cautious on the industrials. IYR, real estate. Now, all real estate is not made the same. You have a number of subsectors in the real estate market. The sector that I like are the REITs, and all REITs are not made the same. You have REITs that specialize in residential housing, office and industrial, mortgage REITs, which I hate, and hotels, which I less hate. But the two I like right now are residential and office, and I'm going to go over that with members in the next several days. I like the real estate sector as long as we hold on to this lower band of the rising uptrend channel. We've broken out on RSI. And you may be saying, Bob, why is it that you could possibly be bullish on real estate with rising rates? The reason is I don't believe that rates are going much higher. And in fact, in the past couple of weeks, they pulled back. Why do I believe that rates won't go much higher? It's because Donald Trump is going to learn to love Janet Yellen. If he wants to get his programs pushed through, he's going to need low rates. And the other thing about rising rates is this. The higher the rates go, the higher our debt interest payments go. We can't afford it. For the past several years, our interest payments on our debt, despite the fact that our debt has surged, our interest payments have gone down, if you could believe it. That's because of the artificially low rates. We've given ourselves a massive loan at artificially low rates. What are we going to do? Bankrupt ourselves by raising rates? I don't think that's going to happen. And even if they do raise once or twice more, you're going to see a rush into real estate to try to capture these still historically low rates before the door closes. So real estate, I still like, unless, of course, it breaks down below this lower band of support. Then we go cautious on real estate. And again, I like the REITs. XLU. Overlaid here in black line chart is the 10-year yield. Now, I've been speaking about this with members for several weeks. We have a divergence that is not supposed to happen. I call the utility sector my canary in the coal mine for yields because utilities are capital intensive. They issue bonds and are perceived as being a higher risk than treasuries. So what do they need to do? They need to compete with treasuries on yield. And that adversely impacts their earnings. So as bond yields rise, utilities have to pay out higher yields, and that hurts their earnings. But what have yields done these past several weeks, despite the fact that yields have risen? The utilities have rallied, and in fact, they have now broken out. This is a canary in the coal mine. If this continues, if we see a breakout, my guess is that, and it's a fairly safe guess, is that we will see yields break down once again, as I just mentioned on the 10-year yield earlier in this video, and there'll be a rush for Yield once again. What else pays a yield? I just went over real estate investment trusts. REITs pay yields. What does well in a rising interest rate environment? REITs and utilities. Inflation is going to be the name of the game in 2017. And if it's accompanied by stagnant growth, well then, that's stagflation, and we're going to need to take a look at the precious metal names. Gold, the gold mining names, silver, even Bitcoin, the bank's monthly chart. Now, the rally in the banks is for real, and I still think that we have more upside potential. We're probably going to go up to 25.40, retest the upper band of resistance, especially if Dodd-Frank is further repealed. They've already had a partial repeal on it going back to 2015, and I would expect under the Trump administration to see further deregulation of the financials, so they should do well. If yields do continue to rise, their NIM, their net interest margin, should do well as well. For that, I would look to the regional banks because they have more exposure to the mortgage market, less exposure to trading, which makes them less volatile. Healthcare. We are in a tight pennant formation. As it stands right now, I would not buy the healthcare sector. I would wait for a breakout above this upper band of resistance. We did see a head and shoulders setup, left shoulder, head, right shoulder. The neckline was broken, but we bounced off the lower band of support. So we're in a consolidation range. But what I will point out is that while we haven't broken out on price, stochastic is beginning to put in higher lows, as is RSI. Down volume is declining. My concern is what happens when they repeal Obamacare. What will that do to the healthcare sector? I'm not that smart. So we'll see what happens after the repeal occurs. The biotechs, which I would trade on a breakout, very similar to the XLV. I would not buy them yet. I would wait for a breakout above this upper band of resistance on this weekly chart. If it breaks down below 35 on the BIB, it's all over for several months, and I'll revisit it some other time. And if you step back and you take a macro view of the BIB, you have a head and shoulders setup, left shoulder, head, right shoulder. Here's your neckline. So again, if it breaks this neckline, it's all over for a while for the biotech. So just be cautious. Now let's talk about gold and silver using the XAU. We bottomed out. I believe it's a bottom in the gold and silver market, unless the dollar does rip higher up through that weekly resistance level I just went over. The bottom, I think, was put in on tax loss selling the week of December the 19th. We had a big week last week. We sold off the highs of the week as we hit the upper band of resistance, and we'll probably consolidate within this range. I plan on trading the NUGT. I already have a position in it. I'll be selling calls, selling puts, building a position further as we consolidate, bringing in premium, pretty much the exact same way as I did it last year. So to recap, my prediction for 2017, at least the first half, because it's difficult to predict an entire year. I think that at the beginning of this year, it will be volatile. I think that those who did not want to sell for tax reason before the new year will sell. I think that President-elect Trump will make nice with Janet Yellen, who will remain accommodative to the market, and that's bullish. So while in the short term I am bearish on the market, if Janet Yellen remains on hold with yields and inflation does not rise, I think that the markets can rally. But if I am right and inflation rises and she allows this economy to run hot without raising rates, you're going to see pressure on stocks. You're going to see commodities rally, rip through the ceiling if inflation hits and we have stagflation going on. Because as it stands right now, we are behind the curve. The Fed is behind the curve. They've only had 2 interest rate hikes in the past 13 months. And only a quarter of a percentage point each. Now, if they step in the back half of the year, if the economy begins to melt down and they begin to offer a QE4 program, which is inevitable from my perspective, you're going to see a dollar crisis, and you're going to see gold, the gold mining names, silver, commodities, both agriculture and mining, just rip through the ceiling. And I wish everybody a very, very happy 2017. Please join our Facebook discussion group, join our 14-day free trial offer, and join with us for another great year. Happy 2017, everybody. Be well.